Welcome to the Cash Flow Chronicles. I'm your host, Jonny and the founder of Cattani Capital Group. For the last 2 years, I've been studying alternative assets and now help solve the problem of creating passive cash flow for creators, influencers, and busy professionals by bringing you 5 episodes a week of easy to understand education in the world of passive investing. What's up, guys? Welcome to another episode of the Cash Flow Chronicles. I'm your host, Jonny Cattani, and welcome to another solo episode. Probably starting to see a lot of these. I'm really starting to enjoy them, honestly. Really today, not a lot to touch on. And so just going to give some updates, kind of current event stuff. The March inflation report is out. So that's going to be the biggest thing we're going to touch on and kind of how that relates to real estate and kind of the overall market and landscape of things. So if you haven't seen, big news. March inflation report came out, and the consumer price index rose 0.1% in March and 5% year over year. So 5% between March of 2022 and March of this year. And that is lower than the 8% that we were, 8-9% that we were seeing back in the fall and winter of last year. And, coming into 2023, we were seeing, mid sevens and then a little over 6%, I believe, in February. So things are starting to trend downward in terms of consumer price index. So you may be seeing it, right? And feeling it. So the consumer price index is going to relate to obviously pretty much all consumer goods. Obviously the two biggest are going to be food and energy, right? Which is basically what we need. And also it is going to include shelter as well. So for those of you who are coming up on new leases, so if you're renting and your lease is coming due shortly, you're probably not going to see a huge increase as you did, between 2021 and 2022. So basically, depending on where you are, between 2021 and 2022, you were seeing, honestly, on average, I think the country average was like the nationwide average was like 8%, could even have been as high as 12%. Some markets seeing much higher. Whereas now you're starting to see some markets go stagnant, meaning that there was no increase, or you're always going to see at least a 2% increase because that's going to be your standard 2-3%, maybe up to 5% depending on the market. But that's a small increase, right? Over $1,000, you're talking about $20, right? So not anything detrimental that's going to crush the wallet. So things are starting to stagnate in housing, and then this is also going to relate to the supply chain. You guys may have seen that last year there were huge bottlenecks in the supply chain. This had to do with numerous things, which I won't really go into, but those are starting to smooth out. Shipment container prices are actually back to pre-pandemic levels. Demand for things have gone way down, which certainly is obviously going to reduce the supply, right? If not, people don't need as many things. Manufacturers aren't going to produce them, which means that companies aren't going to request them. And it's just going to move on down the line and eventually get to the consumer who pays a lower price or something because not as many people need that widget, right? And so how this fully relates all the way back to real estate in terms of from the investor standpoint. So I just talked about as a tenant, a renter. What this is going to mean from the investment standpoint is that you're going to see prices for assets, whether that's a single family rental all the way up to, apartment complexes, different things like that. How that's going to relate is prices are going to start coming down. If rents are not increasing, which is really one of the main ways that you are able to add value to to an asset, to an apartment complex in this case, then prices can't really increase that much. And if, I talked last Friday about, investing in Class A and the different classes. And so from an investment standpoint, if a Class A multifamily apartment complex is now stabilized, Class A meaning it's brand new build, it's now stabilized, meaning it's at 90% occupancy or higher, and everything's brought to market, and you can only increase the market 2% the next year. Well, the price of that asset's not going to go up much because there's not really going to be any more value for the next owner, which means they're not going to want to pay some, huge premium for the asset, which ultimately means we're headed towards a market correction. Now, that's not to say that there aren't other things that are going to bring asset prices down. Starting to see things happen. May not have heard about this, so I'll go ahead and drop a bomber on something that happened in the Houston market in terms of multifamily. There is a group, Appleways investment group, that defaulted on $230 million in debt in Houston. It was 4 assets. It was 3,200 total units that were foreclosed on between 4 different properties. These were mostly Class C value add properties. So I've talked about this. This is typically workforce housing where you're going to come in very underutilized underbuilt. Typically, these are going to be like 1980s and older vintage, right? So built a long time ago. A lot of times haven't been upgraded for 10, 15 years, which means you come in, you upgrade. The upgrades aren't crazy. You're not talking granite countertops and stainless steel appliances. You're talking, laminate, you're talking quartz countertops and laminate flooring, ripping out old carpet, putting in laminate flooring, maybe new carpet in the bedroom, some new paint, maybe some newer fixtures, maybe you paint the cabinets, right? So, and relatively speaking, very, very under lower budget, right? Because, workforce housing, these people don't need these crazy amenities. They typically can't afford to pay rent over $1,000. So, you're maybe now, the reason that this is so appealing to investors is because sometimes you're talking about being able to raise rents from, $500 to $800, which is massive. I mean, on 100 units, that's, 300 per door. That's 30,000, in rental increase. But anyway, I was just trying to paint the picture of what a Class C typically looks like. So if, workforce housing. And so what ended up happening is this group defaulted on $230 million worth of loans, 3,200 units. One of them particularly was like the mayor had a meeting with the ownership group and was like, hey, this place, like, this isn't okay. Talking about like vermin and, trash, dumpsters overflowing, that trash was taking over the parking lot. So there was a reduction in parking spaces. It was bad. And so now you see that, they weren't able to raise rents. They weren't doing anything that they promised they were going to do. You're talking over $60 million in investor capital gone, like won't get it back. Can't get it back. Like there's nothing to go after, right? Because, and, I don't want to paint a doomsday picture because that's not the point here. There's going to be plenty of assets that the debt is fine. Even if they're up against it, they're going to take the necessary steps and investors are going to be just fine. So I wanted to bring this up because I want you guys to see the overall landscape, right? So inflation's finally coming down and, what that means is that eventually interest rates will start to come down, but the deals that have happened over the last couple of years when interest rates are going through the roof, and they're all on this floating rate debt, they're going to be in trouble. So this is why it's so important to know your risk tolerance, which I've been talking about on my Friday follow-ups, and there will be more for tomorrow's episode as well that will relate to this. So I'm not going to go into too much detail, but I just wanted to bring it up and kind of tease it to let you guys know that it's happening, right? Foreclosures are happening. There is going to be a rebalance in terms of the commercial real estate landscape. And so this doesn't just affect multifamily. You look at something like self-storage, right? I talked about earlier, people are buying less stuff, less demand for stuff, which means there's less stuff to store, which means people don't need storage units. They may not need it anymore, or may not need as big of one as they would have previously. So you can see how all of these little things, these tiny little moving parts, all relate and all, come together. And here you have very basic of economics, right? And why everything's related. And the oil in Russia and the issues in Russia relate to the energy here and the oil prices here, and why Russia and Brazil and Mexico, all combining forces on the energy front and working towards getting not trading energy on the US dollar, how that relates and what that can do for the economy. So it's all related. And, ultimately what we're looking at from the Fed is potentially another rate hike. Despite inflation dropping, they really want to get their inflation down to their mark of 2%. And so you're potentially looking, when they meet in May, about a month from now, another 25 basis point rate hike, 25 bips, 0.25%. However, you want to call it. That's what we're looking at. So that's basically what I wanted to explain today. I wanted to explain how it all relates and what's happening in the marketplace and why this interest rate hike, what it has to do with the marketplace. So tomorrow's episode, I will go into more depth on the Houston debacle and what that means for the overall market. And more importantly, what that means in terms of determining your risk tolerance. So thank you guys so much for listening. As always, I appreciate it. You can follow me on social media at Jonny Cattani, Jonny with no H. Go to investwithcattani.com, join my list, get on there. I'm working on a video series to help you guys understand passive investing, 5 steps to your first investment. Part of this will all be on there as well in more detail. So if, the risk tolerance series and all of those have been, haven't quite answered all of your questions, that should answer all of your questions and help you get a better understanding of, determining a risk tolerance. And oh, by the way, we're going to do deep dive into a deal, a real live deal, and there will be some really, really good value there. So thank you guys so much for listening. I will talk to you tomorrow. See ya. Thank you again for tuning in. Who do you know that wants more cash flow? Share this episode with them so you can grow your cash flow together. If you enjoyed the show, make sure you're subscribed on your platform of choice so you never miss a new episode. Go to CattaniCapitalGroup.com to learn more.